So apparently, the United States is about to go broke once again.
We begin our report with the recognition that we are in extraordinary times.
This is the national debt, the total amount that we, as a country, owe to our creditors, the combined sum of all our annual federal budget deficits lumped together.
But as the countdown to potential calamity ticks closer to zero, the U.S. Treasury is buying America more time by taking so-called extraordinary measures. Because if the government hits its borrowing limit,
you have a real mess on your hands.
Throughout the United States' long history, we've collected a lot of debt in order to pay for things like infrastructure, roads, bridges, and social and retirement programs. Now, the US pays for all those things by collecting taxes, and ideally, a country should spend less than what it makes, kind of like a business. But if a country spends more than what it makes, then it has to run a deficit.
Well, government spending rose about 13%, even as revenues coming into the government fell by about 3%.
So translation, the US is spending more money, it's making less money, so it has to borrow more money. So far this year, for example, the budget deficit is up 96% as compared to last year. And a big reason why that is because interest rates are also extremely high. And that's not only harming the middle class, but it's also harming the U.S. debt as well.
The federal deficit swelled by about 96% between March of last year and March of this year. And the government is now estimating that it could pay around $900 billion in interest alone just this year.
We've now spent over $430 billion more this year than we did last year. And that brings the total national debt to $31.4 trillion. And that means we've reached the debt ceiling. Now, to give you an idea of just how much $1 trillion is, that's a million millions or 1,000 billions. And to give you an idea of just how big a billion is, if you counted from 0 to 1 billion without ever stopping, it would take you 31 years to do it. But if you counted from 0 to a trillion, you'd never make it because it would take you over 30,000 years. And that's just 1 trillion. And that's the problem. Because over the next 10 years, the United States is estimated to reach $50 trillion worth of debt. So in today's video, I want to help explain exactly what this means, who the US owes all this money to, and what this means for savers, investors, and the middle class. So let's get into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for one of the most exciting things happening in the economy this year, which is the national debt. Now, so far we owe over $31 trillion as a country. So let's compare that against how much we make, aka the GDP, because after 2012, the US debt to GDP went over 100%. So here's what that means. Let's imagine that magically the government was able to snap its fingers and overnight the tax rate went to 100% for every person. That means for every single dollar that you made, you had to pay back to the government. And let's say the national debt at that point was 0. That means at that point in time, it would take the US government exactly 1 year to pay off its national debt for that year. That makes sense. But when that number goes above 100, like it is right now, that means we're spending more than we're able to collect, which means theoretically, we'll never pay down the debt because the national debt will continue growing far faster than we're able to pay it down. And over time, that has the effect of slowing economic growth because as the debt grows, combined with higher interest rates like we have today, it means more of our payment has to go towards interest-only payments. And that leaves us with less money for everything else like retirement, social security, and of course defense. In 2023, for example, the US will have to pay roughly $900 billion in interest payments alone. Now just for context, in 2022, the entire US had a defense budget of about $1.1 trillion, of which $765.8 billion was spent on the military. So this year, we're gonna spend more in interest on the debt we owe than on the entire military budget. That's roughly 8.5%, or about 1/10 of all the spending of the US, and that's a problem. So unfortunately, that's the situation that we're in, and here's how we got here. But first, here's what you might want to do about it from today's sponsor, Masterworks. Now obviously, most portfolios, including stocks, real estate, and other assets, have huge exposure to the US dollar. That's why most of those portfolios are hemorrhaging money, including most of ours. But there's one surprising asset that might be immune to the decline of the dollar. Just take a look at what the experts are saying. Morgan Stanley highlights this one specific alternative for its, quote, low correlation and lower price volatility, fine art. Now as an asset, it doesn't just help with diversification, but even during bull markets, it was beating traditional investments. According to Barron's, the average price rose 29% last year, beating stocks. No wonder UBS says that median spending on art by the ultra-wealthy has nearly doubled in 2022. And that's why I want to tell you about Masterworks, because I've been talking about them since early 2022, and thousands have already signed up. Like Seth from Florida, who invested over $100,000, Michael from Oregon, over $25,000, or Tony from South Carolina, who invested over $70,000. Now, these subscribers of mine are already part of the Masterworks investor base, which has received over $30 million in payouts to date. In fact, of the 31 pieces that Masterworks has acquired before 2021, they've already sold 13 of them. And half of those sales came just since my last video. Now, as the pace picks up, every one of Masterworks' 13 exits to date has still been profitable, and that's net of fees. Masterworks offerings are all qualified with the SEC, so I've left a link down below with the SEC.gov website where you can check all of their offerings circulars. And I've personally invested into one of their new offerings today. Now, Masterworks has seen new offerings sell out in minutes, and there is a waitlist to sign up, but my subscribers have all priority access to skip the line and start investing right away. All you have to do is click the link below in the description of this video. Thank you, Masterworks, for sponsoring this segment of the video, and now let's get back to it. Our debt is managed by the US Treasury, and it's Congress and the President that decides how much taxes are. But it's the US Treasury that manages the money to pay for things like Social Security and Medicare, which are the two biggest expenses, then Medicaid, the military, the Department of Education, payroll for government employees, and a couple other categories. When the US doesn't have enough money to pay for those, it has to borrow money, aka run a deficit. So you can think of the total national debt as a collection of all the deficits that we've ran throughout the years added up over time that we've never paid back because we just keep on borrowing. So the question is, who does the US borrow money from? And the answer is technically from itself and from you. The way the US borrows money is by creating treasury bonds, and investors then buy those bonds. Now, in exchange for us investing into the treasury bonds, we make money from the government because they pay us interest. And at the end of the bond's maturity, we get all our money back plus all the interest that they paid us. US treasury bonds, by the way, are the most held security in the world. And here's a breakdown of who owns those securities, aka our debt. Roughly 75% of all the US debt is held by the public, but the public also includes foreign countries and investors. And believe it or not, the number one foreign investor of our debt is actually not China, it's Japan. Then it's China, followed by the United Kingdom, Belgium, and Luxembourg. Now, those foreign investments, aka the US owing all those other countries, represents only $7.3 trillion, or about 24% of all the debt. The majority of all the money the US owes, it owes to itself. And the single biggest holder of all US debt is the Federal Reserve. They hold about a fifth of all the debt. And this allows the Federal Reserve to do something called monetary policy through things like quantitative easing, which is the infinite money glitch to stimulate the economy, and the reverse of that, which is called quantitative tightening, where they sell off their balance sheet to tighten the economy and to slow it down, which is what we're doing now. But that's not the problem. It's not about who we owe the money to. The problem is ourselves, and that's because of something called the debt ceiling.
That's the limit Congress puts on how much money the government can borrow to make its payments. The Treasury Department has already started taking steps to delay a default. Right now, that means not investing in some federal retirement funds.
So the debt ceiling is the total amount of money that Congress put on as a limit for the US to borrow by creating those new Treasury bonds. Now, if the US can't pay its foreign investors and its bondholders and itself, then it can default on the debt, which has never happened, but we came close in 2011.
Is this going to be 2011? Because in 2011, during that debt crisis, the S&P 500 was down 15%.
And it wasn't just the stock market that lost 15%. It was also the U.S. credit rating, which was downgraded.
For the first time in the history of the ratings, Standard & Poor's downgraded the United States credit rating late Friday. The agency said it is cutting the country's top AAA rating by one notch to AA+.
Just like people and just like companies, even countries have a credit rating. And the worse the credit rating is, the more expensive it is for those countries to borrow money. And that's why they have to compensate their investors with a higher interest rate for taking on higher risk. But that adds up to more debt and even more bad news.
It would mean that the government couldn't actually issue debt anymore. They'd basically run out of cash for programs that exist.
Around June, the Treasury Secretary estimates, It could mean delaying Social Security checks, delaying tax refunds, furloughing government employees, and even closing national parks and museums.
That's why the US Treasury and Janet Yellen, who's in charge of it, is taking, quote, extraordinary measures to make sure that doesn't happen.
The Treasury uses these extraordinary measures because it's got no alternative.
That the Treasury will have to take what she describes as extraordinary measures to avoid a default. And the White House says, hey, raising the limit isn't up for debate.
We will not be doing any negotiation over the debt ceiling. It's not and should not be a political football.
But of course, it will be used as a political football because they are not united. And because they can't come to an agreement to raise the debt ceiling, they'll most likely ask each other for some sort of a compromise. And this is not the first time that this has happened throughout our history.
The government briefly shut down in 1995 and 1996 when congressional Republicans and President Bill Clinton feuded over the debt limit and government spending.
I also challenge the Congress to preserve the full faith and credit of the United States, to rise above partisanship and pass a straightforward extension of the debt limit and show people America keeps its word.
This usually involves the Republican Party asking the government to spend less money and to cut certain programs it doesn't think are necessary, while the Democrats argue that the budgets for those programs have already been approved. Now it's just a matter of paying for the things that were already agreed to. But either way, the downside to all of this is that while our politicians argue, it's the middle class that ends up paying for it.
When the economy and markets are fearing risk, consumers pay the price, essentially.
This matters because there are real consequences here that matter for if you like money, you will care about this.
Yeah, I mean, massive global recession. How's that for putting it in plain English here, right? I mean, the dollar is the reserve currency of the whole world, and it might not be if we go above the debt ceiling.
Now, throughout the years, there have been a lot of debates on how we solve this problem. And the person in charge of the US Treasury, Janet Yellen, says that we should just come together and agree to raise the debt ceiling.
I believe that the only way to handle the debt ceiling is for Congress to raise it and show the world, the financial markets, and the public that we're a country that will pay our bills.
But if the government can't agree on time to raise the debt ceiling, then other people have suggested that we could theoretically create a platinum $1 trillion coin.
One possible solution to the debt ceiling problem, a specially minted platinum coin worth $1 trillion.
Sounds like an absurd idea, but has rallied support from notable economists like Nobel Prize winner Paul Krugman. He suggests the Treasury Secretary could mint the coin. Mint the coin hashtag is even trending on Twitter.
A potential failure to raise the debt ceiling has the potential to be catastrophic. In the event of something catastrophic, sometimes you might be willing to do things that are weird or different to avoid a catastrophe. There's a law which states that the Treasury Secretary, at the Secretary's discretion, can mint a coin of any denomination. So why not mint $1 trillion coin, deposit it at the Fed, and continue spending the obligations that are authorized by the budget?
That's right. Technically speaking, Janet Yellen could instruct the Mint, which is part of the US Treasury, to create a $1 trillion coin that would then be put into the Federal Reserve, which is money that would then be used to pay salaries, Social Security, and other benefits. And technically, that money would never enter into circulation, which means we wouldn't necessarily see runaway inflation, especially if it's done responsibly. Now, the people that support the idea say that this is way better than defaulting on our debt, having our credit rating downgraded, and potentially losing world reserve currency status overnight. The people that are against the idea say that the entire world would see just how much of a mess the entire US system is, and they would sell their bonds, they would dump them all, interest rates would skyrocket, and as a result, the US would go into a painful litigation process, aka the government would sue itself as it tries to figure out whether that was even allowed to happen in the first place. And if it's figured out that it wasn't allowed, then even worse things would happen. The point is, it's a complicated process that will most likely never happen, and even the person who has the power to do this, Janet Yellen, says she's against the idea of the $1 trillion coin.
I'm opposed to it, and I don't believe that we should consider it seriously. It's really a gimmick, and what's necessary is for Congress to show that the world can count on America paying its debts.
And this ultimately means that Congress will have to get their stuff together and figure this out sooner rather than later, because the question still remains, are we ever going to pay off the national debt, and do we even have to? The answer is technically no, but yes, it's possible that we pay down the debt, but we probably never will. And that's because it's a good thing to borrow money, as long as the US can use that money to reinvest back into itself to increase its own GDP, in the same way that it's a good idea to borrow money in order to educate yourself to get a higher income. That's a good thing. The problem is if your interest rate gets so out of control that it exceeds your income. And the problem with being responsible is that it comes at the expense of cutting spending somewhere, which will upset someone. Or it comes at the expense of increasing taxes, which will also upset someone. And that's why neither political party wants to touch this thing and be responsible, because it comes at the expense of being reelected. Even economists don't know if there's a tipping point to national debt. That's because throughout the years, there have been so many predictions about a recession and the end of the US economy because of national debt. But somehow, we keep on going and we keep on borrowing. The truth is, there is probably a limit somewhere, and that's especially true if the US loses the world reserve currency status and loses the ability to export dollars and export inflation. Because if we do, that means more dollars will stay at home. That translates to higher inflation, which translates to higher interest rates to fight inflation, which translates to higher unemployment and slower economic growth. So the truth is, we'll have to get responsible at some point. But in the meantime, focus on your own investment journey and just keep on going. I hope you have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Don't forget to grab your free stocks. Links are down below, and then go track them automatically with the spreadsheet link down below in my Patreon. Love you. Thank you so much for watching this video. I'd love to see you back here on Monday, Friday, sometimes a Wednesday. See you soon. Bye-bye.